If you invest in stocks, I want to share how you can use cash secured puts to generate income while you're investing. I have been investing for almost a decade and I mentor others as well. Recently, many of the newer investors are feeling stuck. It's a tough time to decide whether you want to buy the dip or cut your losses. So instead of waiting around and doing nothing, my community members and I have been using a few conservative option strategies, including selling cash secured puts. For example, I shared this cash secured put trade within my community, one of my long-term stocks, Futu, which turned out to be a 99% gain. We can also use this strategy on ETFs that we are investing in. For example, the IBIT Bitcoin ETF. This is not a new trick. Selling cash secured put is a common basic option strategy that traders and investors have been using for decades. So there are two main benefits of selling a cash secured put, which will help you grow your portfolio even when the market is down. If you are already investing, you could generate extra income by collecting option premium. I'll explain in this video. You can buy more shares for your long-term stocks at a discount. This strategy just has become a lot more attractive to investors now that we are in a shaky and uncertain time. If you're ready to learn this straightforward option strategy to generate additional income, give this video a like. It doesn't cost you a single thing, and get your notebooks ready. So what is a cash secured put? Before we dive deeper, let's make sure that everyone understands exactly what a cash secured put is. Selling a cash secured put is just agreeing to buy a stock at a specific price. If it falls down to that price or below, you're basically telling another investor, like, hey, if Nvidia drops to $100 per share, I promise that I'll buy 100 shares from you at that price. In exchange for this promise, that investor pays you money immediately. This money is called the option premium. Here's the important part. You only make this promise on stocks that you already want to own at a lower price. So only on stocks that you already had your eyes on and was already thinking about buying anyways. And this strategy is called cash secured for a reason. You must set aside enough cash to fulfill your promises just in case if that happens. So if your promise is to buy 100 shares of Nvidia at $100, you must have $10,000 in your account set aside. Now let's simplify why this is beneficial for you. First, if Nvidia doesn't drop to $100, you don't buy this stock, but you keep the money, the premium, no matter what. And second, if Nvidia does drop to $100 or below, you buy those 100 shares. But remember, you already got paid that premium. This means your actual cost for Nvidia is lower than $100 per share because you subtracted the premium that you received. Let's use my real cash secured put trade, for example, to explain this once again. I shared this trade with my community on the day that I opened this contract. I sold a cash secured put on TSM stock, that's Taiwan Semiconductor Manufacturing. Let's break it down step by step. The strike price was set at $182.50. The expiration date was November 8th. This was in the past. I got paid $126 as the premium for agreeing to this trade. So when I sold this put, I am agreeing to buy 100 shares of TSM at $182.50 per share if the stock does fall to that or below by November 8th. Because I'm agreeing to buy 100 shares, I have to have enough cash in my account to buy those 100 shares if the strike price does hit. This amount was $18,250, also known as my collateral. How you get this collateral of $18,250 is simply multiplying the strike price of $182.50 by the 100 shares. Because remember, you have to have enough money sitting aside for that agreement just in case if that happens. But here's the cool part. Right when I placed this trade, I immediately got paid that $126 as premium. That's mine to keep no matter what happens. Now, there's two things that can happen next. Scenario number one, if TSM stays above my strike price of $182.50 by expiration date, in this case, November 8th, I keep the entire premium and the put option expires completely worthless. That means I do not have to buy the stock at all. And my $18,250 collateral gets returned back to me right away. Scenario number two, if TSM does dip below $182.50 by November 8th, then I'll have to buy the 100 shares at that strike price. But since I had already received a premium, my real cost per share is actually lower to around $181.24. And the reason why this strategy works so well is because I only sell puts on stocks that I am comfortable owning for the long term anyways. I picked TSM because it's fundamentally strong and I believe in its long-term potential. And if I end up owning the stock, that's completely fine with me. I'm buying shares at a discount. And if not, I walk away with the premium. In either cases, I would rinse and repeat over and over again. This is a simple yet powerful strategy that lets me generate additional income consistently and steadily grow my portfolio. Now, let's talk about exactly what could go wrong and how you can protect yourself when selling a cash secured put. Risk management. How to protect yourself when selling a cash secured put. Selling a cash secured put is a conservative option strategy, but like any other investments, it does come with some risks. So let's go over the potential downsides and how you could protect yourself. Your number one risk, the stock drops below your strike price. The main risk of selling a cash secured put is the stock price could drop significantly below your agreed upon strike price. Let's use TSM trade as an example. I agreed to buy 100 shares at $182.50. But what if TSM crashes to $160 by expiration? I still have to buy at $182.50, meaning I'm down $22.50 per share right away. So I have 3 actionable steps on how to minimize your risk. Number 1, only sell puts on stocks that you actually want to own. If you want to be comfortable with holding the stock for the long term, then don't sell puts on it. Number 2, choose a strike price that you're happy buying it at. If you think a stock is overvalued at $182.50 per share, then sell the put at a lower strike price. And number 3, look at support levels on a chart. Avoid selling puts right above the major resistance levels where breakdowns could send the stock lower. Risk number 2, risk of market crash. Sometimes an entire sector or broader market could take a hit, and even strong stocks can get dragged down. For example, in 2022, semiconductors as a sector took a massive hit, and even high-quality names like Nvidia and TSM dropped by 50% or more. If you sell puts and the market crashes, you could end up buying shares at a much higher price than the actual market price. So based on my personal experiences, I only sell puts on stocks that have strong fundamentals. Even if the price drops short term, fundamentally strong stocks tend to recover over time. Number 3, managing puts before expiration. You don't have to hold a put contract until expiration. If a trade starts going against you, you have the option to cut it early and incur a small loss. For example, if TSM drops to $175 a few weeks before my expiration, I could either roll the put to a lower strike price or buy the put contract back early to limit my losses. What rolling down means. If a stock starts dropping, you have the option to roll your put contract to either a lower strike price or extend the expiration. This gives the stock more time to recover. Buying back the put early is another option. If the market turns against you, you can close your position before it gets worse. You can take on a small loss, but you avoid a bigger one later on. Risk number 4, high implied volatility traps. When volatility is high, premium looks juicy, but the risks are a lot higher. For example, during earnings seasons, premiums can spike because of uncertainty, but selling a put right before earnings can be really risky. If the stock starts to drop, you might get assigned those shares at a really overvalued price. So I would avoid selling puts right before earnings or big news events. Stocks can move unpredictably. Sell puts during calmer periods. You don't need to chase the high premiums, just focus on consistent and steady income. Selling cash secured puts is a powerful way to generate income, but only if you manage those risks properly. Here's the golden rule. Sell puts on stocks that you actually want to own at prices you're comfortable buying at. If you follow this rule, even in worst case scenarios, you'll end up owning a stock at a discount rather than losing a trade. Next, I'll show you a live demo on how to place a cash secured put step by step inside Robinhood so you can see exactly how it works. So let's go into my Robinhood app and I'll show you exactly step by step. Alrighty? So remember, for this example, we want to do it on stocks that we already want to own, that we had our eyes on already and we don't mind buying anyways. So for this example, we're going to be using Nvidia. So we're going to be typing in Nvidia over here, and we're going to be hitting trade at the bottom right hand corner and trade options. For this example, we're going to go about 2 weeks out, so April 4th, and you want to make sure that it's on sell and put at that top bar over here. Right in the middle, we could see the current share price at $117 per share. But I don't want to pay $117 per share for Nvidia, but I don't mind paying if it does hit $110 per share. So in this case, we're going to be scrolling down to $110 per share, right? I'm going to be pressing this plus icon at the bottom and then swiping up a little bit. And then for this example, we're going to be doing one contract because remember, every single contract is 100 shares. And I'm going to be punching in this limit price, this bid price over here of $1.23. And then let's review this real quick. So If Nvidia drops down to $110 per share or below by April 4th, I would be obligated to purchase it at $110 per share. Now, in agreeing to that, I will get compensated $123 upfront. Now, if Nvidia doesn't hit $110 and stays above $110 by April 4th, I still get to keep that $123 regardless of which way it goes. So if it does fall below $110, I will still keep the $123. If it stays above the strike price of $110, I will still keep the premium of $123, regardless, either way. Now, moving on to the next thing, the collateral. We can see the collateral is $11,000 over here. Now, you get that $11,000 because you take the strike price of $110 times it by 100 equals $11,000. Because remember, we need to have that cash sitting on the side just in case it does hit $110 per share. So now everything looks good. We're going to swipe up to send the order in. And since it's a weekend, it's not going to go through, but if normal working hours, it should go through. So that is exactly step by step on how to do a cash secured put. So my question for you is, do you have any stocks or ETFs in your portfolio that are fundamentally strong, long-term bullish, and suitable for this cash secure put strategy? Let me know what you think about this tutorial. Again, this is not a get-rich-quick trading strategy. The cash secure put is an option strategy for long-term investors who understand the key price levels, such as supports and resistance levels, to generate additional income while investing. If this tutorial has been clear, please hit that like button and drop a subscribe. It's completely free and it really does help motivate me to make more educational videos like this. I have another option strategy suitable for most investors, so check the video out over here to learn my LEAP option strategy, and I will see you in the next video.